Ladies and gentlemen, it is not over. We have just seen round one of what's going to be more and more bank failures. And we just got news today that Moody's has downgraded not just one, not just two banks, but the entire US banking system from stable to outright negative. Many people think that the Federal Reserve has saved the day and the crisis has been averted, but when we look back at history, this just may be the first of many bank failures to come. So in today's video, we're going to dive deep into the US banking system, show you there's much more problems underneath the hood to show that the US banking system is a complete Ponzi scheme and things are rotten to the core. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, okay, everyone, look at this. This is absolutely massive, and this is showing that many people are losing faith in the US banking system, and there's going to be more bank failures coming. And I'll get into in a moment what banks I think will go under next. But listen to this. Moody cuts outlook on US banking system to negative, citing rapidly deteriorating operating environment. So that's exactly right, everyone. We saw 3 banks collapse in just a matter of a week, and Silicon Valley Bank collapsed in just 48 hours. I think the banks are taking a breather because of the Federal Reserve's bailout, and that's right, I'll get into a moment. It is a bailout, and yes, taxpayers will foot the bill, and yes, bank CEOs did pay themselves big bonuses and sold stocks days before they got this big bailout, so some insider trading. But of course, there's not enough money for the middle class, but whenever banks need money, the Federal Reserve will print the check like that. So as said, we have changed to negative from stable outlook on the US banking system to reflect the rapid deterioration in operating environment following deposit runs at Silicon Valley Bank, Silvergate Bank, and Signature Bank, and the failures of SVB and SNY, Moody said in a report. Now, the reason why this is so critical and so important is because this is going to affect the bank's credit rating. They're already in a liquidity crisis, and this is going to make it even harder for them to raise credit, and also it's going to make it much more expensive. But they're warning these few banks that have collapsed is just the beginning, and there is going to be more bank failures. In its downgrade of the entire sector, the rating agency noted the extraordinary actions taken to shore up impacted banks, but it said other institutions with unrealized losses or unsecured depositors still could be at risk. They said banks with substantial unrealized security losses and with non-retail and unsecured US deposits may still be more sensitive to depositors, competition, or ultimate flight, with adverse effects on funding, liquidity, earnings, and capital, the report said. And I'm going to get into in a moment, everyone, the US banking system is sitting on massive amounts of unrealized losses. Moody's on Monday downgraded Signature Bank and said it would remove all ratings. It placed the following institutions under review for potential downgrade as well. So here's who we got to watch next, everyone. So First Republic, Intrust Financial, UMB, Zions Bancorp, Western Alliance, and Commercia. So I completely agree. We've seen these banks, their stocks have been getting absolutely hammered lately. And yes, while they did have a bit of a rebound today, what you have to know, because I have a lot of new viewers at the moment, when there is a crisis, that's when we're going to see the most amount of volatility. And sometimes you'll see the biggest one-day rallies right before a stock absolutely collapses. So just because it's green today, it does not mean the crisis is over, everyone. They said, we expect pressures to persist and be exacerbated by ongoing monetary policy tightening, with interest rates likely to remain high for longer until inflation returns within the Fed's target. And I'm going to get into in a moment the latest CPI report, everyone, and this was a complete disaster for the Fed, because this is showing that inflation is still running very hot, much higher than the Federal Reserve's mandate. So this is checkmate for the central banks. They're completely stuck in the corner, and there's no way out of it without major pain. Either they're going to have to bail out the entire US banking system and cause rapid hyperinflation, or they're going to have to fight inflation, bring it down, and let the banking system collapse. US banks are also now facing sharply rising deposit costs after years of low funding costs, which will reduce earnings at banks, particularly those with greater proportion of fixed rate assets. And they also go on to say it is now pretty much 99% likely that the US is going to fall into recession if we are not in one now by the end of the year. Because have a look at the absolute mammoth losses these banks are having on their books right now that they're trying to cover up and trying to hide. So look at this, US banks sitting on unrealized losses of $620 billion. That's absolutely crazy, everyone. And if you think the Federal Reserve is going to bail out all 620 billion, they cannot do that right now because with the latest CPI report, inflation's still running far too hot, and the amount the US Treasury gave to the Federal Reserve simply is not enough. They only gave 25 billion to backstop some of these losses. The US Treasury is bankrupt. They're in a huge deficit. They still have to try to get their new debt ceiling approved, which of course they will get approved, but they cannot afford to bail out another $600 billion for the banks. And also politically, I don't think they'll be able to do this as well. Now, something else we've been talking about on the channel is the contagion risk, how these bank fails is going to lead to losses for other banks that may have been in good standing, but still they're now going to take a big hit from these losses. So look at this, Morgan Stanley bankrolled funds among those that exposed to regional bank failures. So we can see here, everyone, how the contagion is spreading. Now, Morgan Stanley's taking a hit from this. Our favorite investment institution, our favorite bank, BlackRock, they're now taking hits from this. So we are going to see more and more domino effects fall from this fallout. Now, I just wanted to clear up because there still is a lot of debate whether this was a bailout or it wasn't a bailout. And people, it completely was a bailout, but the current administration is just kind of say, well, no, it's not, so it isn't. Just kind of like what they said last year when we had the literal definition of a recession of 2 negative quarters of GDP. They said, it's not a recession, so don't worry, guys. And maybe when more banks fail, they'll say, look, we're not going to do bailouts. We're just going to do a special financial operation. Look at this. Yellen said no bailout, but it's a huge bailout for the banking system. The Treasury and Federal Reserve stepped in late Sunday to contain the financial damage from Friday's closure of Silicon Valley Bank, guaranteeing even unsecured deposits and offering loans to other banks so they don't have to take losses on their fixed income assets. So this is absolutely crazy, Ron. Imagine if, for example, you invest in some bonds or if you invest in a stock, you have some losses, and then you go to the bank and say, look, I've got some losses on my assets here. Can you just give me my money back or the price I invested in? What would the bank say? They would say, no, of course not. You invested your money, you took the risk, now you have to take the losses. Well, it seems like the banks, they can't lose anymore because they're taking huge losses on these bonds. So now what they're doing is they're going to the Federal Reserve, and the Federal Reserve is giving them the money that they paid for those bonds, and they're absorbing all their losses. And who's going to pay for these losses on the Federal Reserve's balance sheet, everyone? That's right, the taxpayers are. Even though the Federal Reserve can create money out of thin air, they're still going to tax us to death. So this is a de facto bailout of the banking system, even as regulators and Biden officials have been telling us the economy is great and there is nothing to worry about. The unpleasant truth, which Washington will never admit, is that SVB's failure is a bill coming due for years of monetary and regulatory mistakes. So that's right, everyone. The banks got free money. They printed money like crazy. We saw a huge speculative frenzy in the stock market, in real estate. They thought the party would go on forever, and they capitalized the gains, but now they're socializing the losses. And it's funny to me that Americans still think that they have capitalism, and they think capitalism the reason why the middle class is getting destroyed. No, capitalism would be, okay, you create a bank, you take some risk, you fail, you go under, you get no bailout, you get nothing. What we have right now is capitalism for the middle class and socialism for the super rich. Wall Street and Silicon Valley were in full panic over the weekend, demanding that the Treasury and Fed intervene to save the day. It's revealing to see who can keep a cool head in a crisis, and it wasn't billionaire hedge fund operator Bill Ackman or venture investor David Sachs, both frantic panic spreaders they were. That's right, everyone, and you know what's funny? Bill Ackman, this snake that he is, he's actually an advisor on the Federal Reserve board for investment committee, and he had investments in a lot of these startups that had their money frozen at Silicon Valley Bank. So of course he cried for a bailout so he could get his money back, and you can't make this stuff up. He obviously brought the regional banks when they crashed, and then he told everyone to go in there and buy, and then the bank stocks rebounded the next day. So we completely see how these billionaire hedge funds manipulate the markets, and they have very close friends at these central banks, at the Federal Reserve, and also in the US government, because it's like a revolving door with the government and the banks. You'll see someone from the banks go into the US government, and then all of a sudden they'll make some regulation that's friendly to the banks, and then they'll go and get another cushy position at another hedge fund. The Fed said they'll guarantee even unsecured deposits at SVB, as well as Signature Bank in New York. Typically in bank failures, those deposits will get their money back with a 15 to 20% haircut. This would no doubt be a hardship for many customers, but the $250 limit was known. So that's right, everyone. This wasn't a bailout of the middle class or the average American. This was a bailout for the super rich. The average deposit at Silicon Valley Bank was around $2 million, and 95% of deposits were over the FDIC limit of $250,000. All these people put their money in the bank knowing this risk, they took it, and then they still cried for a bailout. And you know what's so funny is at Silicon Valley Bank, with the regulations they tried to make, they tried to say, look, we're not a systemically important bank, so we don't need all this regulation. But when it came to their banking collapse, they were saying, look, we're so systemically important, you need to give us a bailout because we're too big to fail. Well, no, they're not too big to fail, everyone. And it's funny how we've gone from, okay, these institutions are too big to fail, so we need to bail them out, to now, we need to bail out everyone, because that's how weak this financial system is and how much of a house of cards it is. Once people lose a little bit of confidence in the banking system, we could see it could fail in just a week. But there could be political risk from bailout too. If the administration acts to guarantee deposits without congressional approval, it will face legitimate legal questions. That's exactly right, Ryan. It'll be very interesting to see what happens with these banking executives when they get brought before Congress. But everyone, let's go back to what's going to happen to the US economy and ultimately how this is going to affect the entire banking system and why Moody's is very, very worried. So look at this, everyone. Every part of the Treasury curve is now flashing recession warnings. So all benchmark Treasury yields fall below Fed's target, and such inversion was followed by recession every single time but 1998. So this is very, very worrying, everyone. The bond market is signaling that every single yield on all bonds from 3 months to 30 years is below the Fed's target. And every time this has happened, there has always been a recession. So since 1977, such a move has been foreshadowed every economic downturn. According to data compiled by Bloomberg, its predictive powers were off only once in 1998 when the Fed slashed rates after the collapse of hedge fund long-term capital management, but a recession never materialized. And you can see with this chart here, everyone, every time this happens, where is a recession? In the 80s, in the 90s, in the early 2000s, 2008, and 2020. Because we got more news today to show that the unemployment rate that's been holding the economy up is about to go much higher, and there is more layoffs coming. Look at this. Meta cuts another 10,000 jobs as tech layoffs accelerate. So what I think is going to happen is we're going to see more and more tech layoffs because they had a lot of money in these banks, and now they're going to have maybe some losses, or they're going to be very, very worried about their capital, wanting to conserve their capital, and there's going to be more layoffs in the tech sector, and that's going to lead to more layoffs across the broader economy. But what I think is the biggest issue is, unlike 2008 when we had a banking crisis, the central banks didn't have an inflation problem, so they could cut interest rates to zero, they could print money like crazy because the CPI was below the Federal Reserve's target. But this time is very, very different, everyone. I know that's famous last words, but it is different every single time. And we have a severe inflation problem, and the latest CPI report revealed it. So look at this. US CPI falls to 6% in February as expected, but core prices are still strong. So core prices still rose 0.5% for the month. When you annualize that, that's 6%. That is triple the Federal Reserve's mandate. Now, the Federal Reserve's going to be stuck in a very, very tricky situation. Again, they're backed into a corner. There's no way they can get out of this without major pain. Either they're going to have to fight inflation and risk collapsing the whole banking sector, or they're going to have to bail out the entire banking sector. If they do that, we're going to see a melt up in the markets, like what we're seeing with cryptocurrency right now, like what we're seeing with some banks rally today. We'll see a huge melt up. Then that money is going to be taken out of the financial system like in 2020, and they're going to take that money and spend on consumer goods, and inflation is going to surge higher, and it's going to lead to a much bigger crisis down the road. So it's going to be very, very interesting to see what the Federal Reserve does at the next meeting. They definitely need to keep on hiking. I think 0.5 percentage point like they were going to before, but they may pause at this meeting, see what happens with the banks, and continue hiking the next meeting. So everyone, I just want to reiterate, you cannot take your eye off the banks yet. This may have just been round one, and we are going to see round two of more bank failures. But everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.